Well, good afternoon, everyone, and welcome to our weekly webinar where we will talk about what we see happening in the global economy and financial markets and the world of wealth management and how all of this impacts our decisions on the best courses of action for your investment strategy and financial goals. Well, there's certainly been some significant developments over the last week, so sit back, relax, get some popcorn, and enjoy. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. I'm Scott Tomlinson, and I'm joined by my partner and colleague, Paul Tepsich, the founder of High Rock, and our financial planner, Bianca Tomlinson, is also on the call. We will have a question and answer period at the end of the call, so if anyone has a question about any aspect of wealth management, we certainly invite you to feel free to ask questions. And remember, if you have a question, it is likely that other listeners may have the same question, so please definitely feel free to engage us. For those listening for the first time, High Rock was founded by Paul in 2010 to manage about $200 million in closed-end funds for Scotiabank, and we are registered with the Ontario Securities Commission. I joined Paul in April of this year to help build our private client business, and we are 100% employee-owned. Now, we're excited to have our unique business model already making an impact. All of our new clients are coming to us because they really like our patient, no-nonsense approach to investing in wealth management. So if you like what we are doing, our approach, our service, and our expertise, please feel free to recommend us to your friends, family, and colleagues. We do have room for some new clients who might make a good fit to our style of low-cost wealth management. Our private client division was established to take advantage of some of the synergies that come with the funds we manage for Scotiabank. Now, we are not brokers, we are not investment advisors or financial advisors. We are a portfolio management company who has a clear understanding of wealth management. Importantly, all of us at High Rock have our money invested in the same models as all of our clients. Whatever we do for all of us. Our interests are completely aligned with yours. Our fees are simple and transparent, and we fully disclose any hidden or embedded costs that may not be the case with most advisors. As we have been discussing regularly, we have come through a cycle of above average portfolio returns over the last 6 years, and as we enter into a period of below average returns that will likely bring us back to the average, it is really important to pay attention to the costs of investing. One of the reasons we are attracting new clients is our desire to keep your costs low. We also take our responsibility to you beyond what is required by the regulators, so we have an independent review committee that reports directly to our clients to ensure them that we are fulfilling our obligations to them as we stated we would. This report is sent with your quarterly update and portfolio progress reports. Well, fees truly do matter, and if you look at the impact of fees over time, it really can be astounding. And more importantly, you need to ask yourself what you're paying for. At High Rock, you get a well-forecast, disciplined, active, tactical portfolio management, which you do not necessarily get with many advisors. And I'll talk to this in a little more detail as we move along in the presentation today. We also have my daily blog, our weekly webinar, which you're listening to now, to keep you current on our thinking. We also send out quarterly reports. And you're invited to have as much interaction with the portfolio managers as you wish. And that's something that very few fund managers, if any, will actually do, and that's talk directly to clients. Well, in light of the market turmoil, yesterday we were in touch with almost all of our clients individually to let them know that their portfolios were going to be okay. Because we care, and we really do care, and that's why we are in this business. Essentially to look after you, and that's what you're paying us for, and importantly, we actually like looking after you. Well, it's easy for an investment advisor or portfolio manager to get you fully invested after you sign up with them. They'll sell what you had and put you into the investments that they want you to have at that moment in time at whatever price is available. That's easy work for the advisor. It's a great deal more work to pick the right purchase points. Sometimes it may require patience and often some explanation as to why and what's happening. In fact, some assets may take months and even years to get into a portfolio. As a result, risk management becomes very important because we must be vigilant not to put our clients' money at greater risk in order to chase higher returns in the short term. We have to take a long-term view to make sure that clients get invested at the appropriate time. Part of the discipline that we bring to the table is in picking the appropriate price points for buying new assets. This is part of the value that HighRock adds to our client portfolios. Yesterday, our patience and risk management over the last 5 months since we began the private client division paid off for our clients. We were able to get some excellent prices for assets that we've been waiting for. Well, there are many risks that we need to focus on an ongoing basis. The goal in managing all of these risks is to reduce overall volatility in our portfolios. Well, this week, equity markets have fallen by between 10 and 15%, while our models combined are down somewhere between 1 and 3%, depending on the structure of a personalized client strategy. Now, our ongoing efforts for the management of your portfolio strategy is to find the best possible returns and, at the same time, try to provide the least amount of risk in doing that. Naturally, this is done in the context of each of our clients' specific goals and their tolerance for risk. Now, our research shows that a globally diversified and balanced 60% equity, 40% fixed income model can significantly reduce risk and still achieve an annualized return of somewhere between 7 and 8% over a multiple year period. This is what we consider to be the optimal portfolio. Of course, rebalancing on a regular basis is crucial. Different asset classes will outperform or underperform at different times in a market cycle. Selling those outperforming assets and buying the underperforming assets will continually add value and return. Eventually, underperforming assets will return to better performance, and at the same time, outperforming assets will ultimately underperform. This is how profitability is realized and new cash gets reinvested. So our discipline is our strict adherence to your goals-oriented investing, our structured models, protecting your capital, regular rebalancing, and in-depth research, fiduciary responsibility, and a very high level of client service. As many of you know, at HighRock we have 3 models with which we can create balance and diversification. Fixed income model, government, investment grade, corporate bonds, and a small percent may be high yield corporate bonds. And we may include also a selection of preferred shares here as well. We have a global equity portfolio that focuses on diversification across thousands of companies in multiple economic sectors and many geographic locations. And as well, we have a model that focuses on Canadian small to mid-sized companies with which we have a great deal of familiarity and deep levels of research. This is an active or tactical model intended to obtain better than average growth. For our clients, we use these models to create portfolio strategies that are in keeping with your desired goals. Now, we have a number of themes that we've been following regularly through 2015, and of course our regular listeners will know them, but I'll just go through them once again. Certainly, one of our themes has been to expect the unexpected, and yesterday was no exception to that theme whatsoever. The VIX index, the measure of volatility on the S&P 500, hit levels up in the mid-50s. Now, these are levels we've not seen since 2009. I don't think anybody had this on their radar screens. I certainly didn't. But also one of our themes for 2015 is that we have continually suggested that equity markets were expensive. And last week on this call, we said not only are we seeing the divergence between corporate bonds and stock markets, but revenues and earnings are not growing and are not expected to grow even in the third quarter of 2015. Well, eventually the fundamentals have to come into play. Here's another chart we've been showing for the last several weeks, calling for an eventual correction of somewhere between 12 and 20%. Well, yesterday we had a correction that showed up to be pretty close to that 12% level. There still may be some downside. We'll have to be keeping an eye on that one for some time to go. But honestly, we did not expect it to happen in a 3-day time frame, and It still remains to be seen if we actually have seen the bottom yet. But we were definitely right on our call and have been making sure that our clients have benefited from this. As a discretionary portfolio manager, we were able to quickly adjust some of our buy orders yesterday, and when we realized that we had an opportunity on our hands, this allowed us to certainly take advantage of some very good prices. But we can still afford to be patient. We need to see how these higher levels of volatility will play themselves out. Historically, higher levels of volatility have pointed toward a potential change in the trend. So this may just be the beginning of a downtrend. We've got to monitor this very closely, as I was saying before. We have been showing this slide every week for some time. Definitely that on an enterprise value to earnings basis, stocks have been expensive. Today they are still relatively expensive, but certainly a lot less so. As portfolio managers with a long-term perspective, we believe that markets are cyclical. Many remember back to the lows of 2009 and the emotional concerns that went along with them. Well, I remember having multiple conversations with clients explaining that we were at cyclical lows. Certainly, we are now off the recent cyclical highs for equity markets, but it's not exactly clear how far into the cyclical downturn we moved with yesterday's sell-off. So again, this is something we're going to have to monitor very closely. We've also been pointing to the bond markets as our guide as to what is coming in equity markets. And last week, we pointed out that U.S. high-yield bond markets had turned lower ahead of the S&P 500, and that traditionally, this was a good leading indicator. Well, yesterday, lo and behold, stocks jumped ahead of high yield, outpacing them to the downside. We've often said that high yield is less volatile than equities, and here's a classic example of that. It is why we like the high yield asset class in our client portfolios. More diversification and excellent risk-adjusted returns. Well, also in bonds, the flight to quality yesterday, as risky assets were sold and safe assets bought by market participants, this pushed U.S. government bond yields back close to their lows from April. The 10-year got near to 2%, and in the short end of the yield curve, a September rate increase by the U.S. Fed, which had been partially priced in by the market last week, well, it is now not priced in any longer. So we'll talk a bit more about what central bankers might be up to in a minute. Meanwhile, in Canada, 10-year bond yields have moved below their April 20 lows, so making new lows now. And in the short end, it is basically priced in a 0.25% cut by the Bank of Canada. So again, bond yields are telling us a bit of a story now. In Europe, bond yields have not been pushed as low in the long end, as we've seen some improvement in the euro area economy recently, and this appears to be continuing. However, negative returns in the short end of the yield curve still price in near-term deflationary fears there. In the UK, an improved economy has the Bank of England Governor Carney wanting to raise rates. However, the bond market is telling us that this may not be coming soon as inflation has continued to fall there. Well, further on the inflation watch, deflationary concerns have returned. We talked about this a bit last week, but because of oil and it continues to fall, making new lows and in fact getting very close to the 2009 lows. Now, all commodity prices combined are still well above their 2009 lows, so we'll be monitoring that and how that impacts inflationary expectations as we move forward. But in the non-commodity sectors, we saw last week that prices continue to move higher, as was reported in last week's U.S. CPI data. It does show shelter and apparel prices rising considerably. So the Fed really does monitor the core personal consumption expenditure prices, and they have a target for that at 2%. We have not yet seen the July data for this index, but it's going to be released later this week on Friday. and this may certainly play an important role in the Fed's decision-making process as far as what their next steps are. What's new in economic data? Well, in the U.S., we've seen some third quarter data thus far showing July new and existing home sales being better than expected, and we've seen manufacturing data that is somewhat mixed. So nothing really clear, but nothing showing us any sort of significant booming U.S. economy that had been expected. We also talk regularly about the U.S. consumer, who until recently has been responsible for 2/3 of U.S. economic growth, but we think that this may be changing, and we know that baby boomers who have been the former big spenders and the largest cohort now, the millennials, just don't have as much money to spend. They're facing higher rental costs, and they've been spending money on cars and restaurants over the course of the month of July. So again, we remain to see what happens throughout August. As for other parts of the global economy, well, China's economic growth, which had been leading the global economy for many years, well, it's certainly showing signs of slowing. Manufacturing slowing, and exports have been slowing. So this inspired the Central Bank of China to devalue the yuan, which then sparked fears across the global economy. And as a result, we've seen the Shanghai Composite break down to new lows, up 50%, 57% on the year at the highs, subsequently fallen 41% from its highs, and is now down 8% on the year. So China cut interest rates and reserve requirements once again, hoping that this will be stimulating economic growth and help to stem the tide of the stock market downturn there. What are other central bankers thinking these days? Well, Mario Draghi in the EU is still easing policy. Governor Paulus of the Bank of Canada, he may have to cut again. The U.S. Fed wants to raise rates, but now it is less clear as to when. We said a while back that we did not expect it to happen in September. That is becoming a little bit more likely now with all of the volatility that we've been seeing. Bank of England Governor Carney wants to raise rates too, but the when is still out there as a wild card. Something else that we've been talking about and what we see for this foreseeable future is that with low economic growth, low earnings, low commodity prices, low inflation, low interest rates, we're definitely going to be in a low return environment, and we think investors need to adjust their expectations to prepare for this for at least the next little while. Well, how are we positioning our portfolio models based on our assessment of the current environment? Well, as for our fixed income model, we have three real concerns. First is, of course, interest rate risk, which is the future direction of interest rates and how they affect the fixed income assets that clients hold in their portfolios. We also have to assess the duration risk where we need to assess what part of the yield curve will most likely be impacted. In Canada, we may see further declines in interest rates in the near term until we see signs of economic strength. However, we do also have to keep our eye on Canadian core inflation, which with the most recent data shows running at a level of approximately 2.4%. If you own a bond that has a yield of 1.5% and you've got inflation at 2.4, you're going to end up with a real return after inflation that is negative. Well, we don't want that. Certainly, that will temper our desire to own bonds at these lower yields. So we have to continue to be monitoring that. Finally, we also have to be watching the quality of the bonds that we own. also known as credit risk. There's certainly companies that we want to make sure that if we own them, they're going to be able to make their interest payments and repay their principal. And of course, this is crucial. So we spend a lot of time on this in our research, and especially with our high yield holdings, which may have a little bit more risk attached to them. Preferred shares, another of our fixed income asset classes, have suffered on the back of lower interest rates. In fact, many of the higher yielding issues have matured and been replaced by lower yielding issues. And these rate reset preferred share issues start replacing the once popular higher yielding perpetual preferred shares. That's impacting the Canadian preferred share index, which is now down 20% on the year, and almost getting back to the lows of 2009. This lower return environment is definitely impacting this asset class in significance. And while there are still some higher yielding perpetual preferred shares out there, we continue to keep our eyes on the prices and yields, and they are starting to look very attractive. So this may be an asset class that's clearly underperforming, but perhaps one that should be bought as part of any rebalancing. And certainly this is something we're monitoring closely as well. In our global equity model, volatility has definitely spiked, so we're watching to see if and when this may present some buying opportunities. Certainly we're using our disciplined approach here. Well, so much for the dog days of August. As I said earlier, volatility has spiked to the highest level since 2009, and equity markets have seen a significant shift downward. In the U.S., the long-term trend does still remain intact, but the short-term correction has begun, and it's just a question of when this might actually resolve itself, and there could be lower prices sometime in the future. In Canada, the TSX broke down through its longer-term uptrend line from 2009, so something that we're watching carefully, but definitely there's some opportunity presenting itself. We're just making sure that it's the right time, but we are adding a little bit at lower levels. Japanese equities finally started their correction. They've been hovering at their highs for a long time, but yesterday's market activity certainly brought that on. UK equities continue to move lower. We're monitoring that closely. Euro stocks now below their lows from June, when the Greek issues were in full flight again. In Australia, more decline. So in the developed world, lots of markets are down, and we're continuing to monitor how that all is unfolding. Certainly we saw China earlier, but China's fall has been absolutely amazing, and definitely something I think that's for the record books. Emerging markets definitely following China's example and moving lower. So as we've been saying since we started these calls, we thought equity markets are expensive, and finally we're starting to see the last of the expensive markets cheapen up. So we've got our eyes open, and while we don't want to catch the proverbial falling knife, we know that at some point in time there's going to be some value, and we're going to take advantage of that for our clients when we can. That is it for my stuff. Paul, anything you want to throw up here on the Canadian growth model?
Thanks, Scott. I guess one thing you've shown is the equity markets are starting to look a little cheaper, unfortunately, and certainly we saw it in the TSX chart that you put up. It looks like it's broken down a very long-term trend from 2009, so we are maintaining a fairly cautious approach. We did do a little bit of buying over the last month or so, and those positions are not screaming higher. So trying to be disciplined and find better entry points right now, given that there may be further weakness ahead.
Excellent. Thank you. Okay, well, that's it for today's discussion. If anyone might have a question, please feel free to ask it now.
Scott, maybe I'll start off and ask one quick question. Maybe you can describe how you take advantage of market volatility on days like we had yesterday, or I guess even today, or the last few days that we've had in the market. It's been very volatile, both up and down. And so how, maybe explain to our listeners how we take advantage of that on a couple different fronts.
Well, we always know exactly what it is that we need to buy, and we meet weekly to try and determine what we think are the best price points for those assets that we need to buy. Now not every client is in exactly the same situation. Some clients already have assets, and almost all of our clients, if not every client, is actually underweight equities at this point, purposely, which means they're overweight cash. So any client that has any holding that they need to purchase, we know exactly what they need to buy, and we know exactly what price point we have decided to buy on. Now, certainly on a day like yesterday, Paul and I are sitting there before the open having a conversation saying, is there anything here that looks like it might be reasonable? Or are there any price points that are too high, and do they need to be adjusted lower to see if we can? And we uncovered a few yesterday, and we thought that we should adjust. And the great part of the way we do it and the structure of our operation is that it's done on a discretionary basis. So we can pick the price points. Of course, all of the positions that we need to buy are based on our clients' respective portfolio strategies. So we know well in advance exactly what we're going to buy for our clients. We know the price points. We can adjust the price points. And if we need to act in a very quick way, we have the flexibility to do so with our discretionary management. And that's really important, because an investment advisor doesn't have that flexibility. They have to make a call to each of their clients, get their permission to make a purchase or to take a sale. And of course, a large investment advisor just doesn't have the time to get to everybody in a short period of time. So this is what we really like about what we've put together at High Rock, and I'm really excited about how we're able to be very, very nimble in the market yesterday.
That's great. Can I also add that on one security we bought yesterday, that you got the absolute low of the day?
Yes, that was I put luck in that one, but it's sometimes it's great to be lucky. So that's
good work.
And interestingly enough, that may likely hold for a long time, that low, because that was not something that we really ever expected. So anyway, it was great to get it into our client portfolio at that price.
Well done. Thanks for that execution.
All right. Anybody else have a question? All right. Well, certainly if you do have questions and would prefer to email us, that's great. Those who are listening to the recorded version, of course, please feel free to do so. We also would love to get any feedback that you might have on our webinars. We want to make sure that we're talking about the things that you want us to talk about, so please let us know. But that's it for another week. Thanks so much for being a part of this, for taking the time out of your busy schedules, and I hope you all have a great week, a wonderful weekend, and we'll be back next Tuesday with another webinar. And so this is Scott Tomlinson signing off.